Hi there. In this video, we'll talk briefly about the make or buy or outsourcing decision by identifying some considerations and decision rule, and then just go through a brief illustration, and then we'll go through an in-class problem on it. So outsourcing is where a company decides whether it wants to make something itself or outsource to a third party. And the key considerations in this kind of decision basically include our variable costs in terms of how our cost to make compared to the cost to buy, and to determine if there are any changes in fixed costs. And with these two elements, this makes a make or buy decision, in essence, a cost minimization decision. But then there's a situation perhaps where if you have the opportunity to buy the product that you would normally make from outside, you can free up capacity. So that brings us to this additional component here about freed capacity, which could represent a potential revenue and profit opportunity, which means when we add the option of being able to do something with freed up capacity, this turns it into a profit maximization decision. In essence, the decision rule on whether to outsource comes down to if the incremental costs of making exceed the incremental costs of buying, then we will outsource it. If the incremental costs of making are less than the incremental costs of buying outside, then we wouldn't outsource. It's as simple as that. So here's an example from your text that provides two alternatives. Number one is a make scenario, and number two is a buy scenario. And all we do is we extract the relevant items, which is anything that's about the future and anything that changes between alternatives. So we have our variable cost, which includes direct materials, labor, and variable overhead. And the cost to make them in total is $40,000 for materials, $20,000 in labor, and $15,000 in overhead. Of course, if we buy the liners, then there is no cost. And so we can have a difference column here, which is basically column 1 minus column 2, which is make minus buy, to help us determine what the difference is. And so clearly, the difference is $40,000 higher to make versus buy. For the direct labor, $20,000 to make versus none to buy is also means it's higher to make. In terms of the variable cost, $15,000 versus none if you buy it, so that's also higher to make. Now, also included as a variable cost is the actual purchase cost from the outsourcer. Now, you could do this one first, or you could save this till the end. There are more than one way to solve a problem like this. The company has the option of buying 250,000 units at a cost of 37 cents. And so, of course, if we make the liners, we wouldn't incur the purchase cost. That's why this is 0 here. And then if we bought them, we would spend 92,500. This makes the difference higher to buy. And then finally, in this example, there's also a shift in overhead where $10,000 of overhead is avoidable by buying the liners instead of making. So there's a $10,000 difference here that's higher to make than versus buy. So you can interpret this in a whole bunch of different ways. But when we add the differential column and you see that there's a difference here of $7,500, this means that in comparison to adding the total cost to make the liners of $125,000 and the cost to buy the liners of $132,500, that's a difference of $7,500 in favor of making it, right? Because you can see that it's cheaper, which means that you can either say that it's $7,500 higher to buy or $7,500 lower to make. It really depends on how you want to look at it, but we could say that this is higher to buy. And in essence, we want the lowest cost option because this is a cost minimization problem. So we would go with making the liners instead of buying them. However, in the second part, what they get into here is saying, well, okay, what if we could free up the capacity and make something else? So now we have a slightly different number of options. We still have the option to make the liners, but we could say that in terms of buying the liners, we have two sub-options. 2A, where we could leave the facilities idle, and 2B, where we could make an additional product instead. So what we can do is we can carry down the cost that we already had done and say, okay, well, the cost to make the liners is $125,000 and the cost to buy them, but leave the facility idle is $132,000. And of course, whether we leave the facility idle or make an additional product, the cost associated with the liners is still $132,500. So this is the same number. But this line here is new. Here we have an expected profit from making an additional product. Of course, that will not appear under the option to make the liner. It will not appear under the option of buying the liner and leaving facility idle, but it will appear as an additional profit or a reduction in cost in the column where we would buy the liner and make the additional product. So now we have a different conclusion. We have a difference of $10,500, this time in favor of buying the liners but making the additional product. There are different ways that you could actually even present this. If you wanted to, you could present the expected profit as an opportunity cost under the cost to make the liners, and so it would make the cost of making the liners more expensive. There's all different combinations of ways, and that's what bothers students, is that there's not one correct way to solve these kinds of problems. All right, so now let's look at this in-class problem here, 8.4 on making or buying. So we've got a company that makes sailboats, currently produces 1,200 sailboats a year, and its normal capacity is about 80% of full capacity. So this means that it has available capacity. The company purchases sails for the boats at $260 each, but is considering using the excess capacity to manufacture the sails instead of buying them. The manufacturing cost would be $100 for direct materials, $80 for labor, $100 for overhead, and overhead is based on $72,000 in fixed costs. That's allocated using normal capacity. The president comes to you, the accountant, and said, hey, it would cost me $280 to make the sails, but only $260 if I buy them, so should I continue making them? So our first objective is to prepare per unit analysis of what we call differential costs and explain whether or not the company should make or buy the sails. So here are options. We can make or we can buy, and we have a differential. I'm going to do them just slightly different from the example that we just did. I'm going to put the cost to buy first, just to give you a different perspective. So of course, if I make the product, I don't buy it, and it costs me $260 if I do buy it. So the difference is going to be $260 per unit, and that would be higher to buy. And then if I start dealing with my variable costs that are associated with making it, we have direct materials, which is $100 per unit to make and $0 to buy. This means that the cost to make is higher than the cost to buy, so higher to make. We have direct labor and variable overhead. We know that if we make the product, we'll incur $80 in direct labor, no labor to outsource it. So this would be a difference of $80 higher to make. And actually, if we take option 1 here minus option 2, then this would be a negative around it. If we look at variable overhead, there is no variable overhead associating with buying the sails, but there is in order to make it, but we might have to actually calculate the variable cost of overhead. So what do we know about the overhead here? We know that the total overhead cost is $100, but that's split between fixed and variable overhead. All we know is that that $100 it also includes $72,000 in annual fixed overhead that's allocated using normal capacity. So the question is, how much of that $72,000 in fixed overhead is allocated to the products? Well, if we have $72,000 in fixed overhead divided by 1,200 sails, right, because that's what it's currently producing, 1,200 sailboats, that is a fixed overhead cost of $60 per unit, which means that in order to come up with a total overhead cost of $100, the variable cost must be $40. So we can now go and say our cost to make includes variable overhead cost of $40. When we take 40 minus 0, that is a difference of $40, and this is higher to make. In this question, there is no mention of any change in fixed costs. So the fixed costs are irrelevant. In this question, fixed costs are not relevant because they do not change. And we talked about earlier on in the course. So what we can do now is add up the total costs of our options. So the cost to make is $220 per unit. The cost to buy is $260 per unit for a differential cost of $40. And you can see just by looking at it that this is higher to buy. What I can do is, if I want to determine what the total impact on the company is, if I know I'm going to make 1,200 of them, then that means my total cost to manufacture them, $220 for 1,200 boats, is a cost of $264,000. If I multiply the cost to buy times 1,200, that's a total cost of $312,000. If I take the differential and multiply by 1,200, that's $48,000. I actually have the option, if I wanted to, of leaving the differential out and just focusing on the two columns of make or buy and say, well, isn't the difference between these two $48,000? And which one is less? It's in favor of making. So the decision here would be make the product instead of buy it. But now things change a little bit. If we look at part 2, let's say that the company finds an opportunity to rent out the unused capacity of its factory for $80,000 a year. Would the answer change? Well, let's see. In this situation, we still have the option to make. But now, if we look at buying, we actually have two sub-options as it relates to buying. I can buy and leave my facility idle, or I can buy and rent the space out. Well, here, the relevant costs to make is $264,000. The total cost to buy and leave the facility idle is $312,000. The total cost to buy and rent is still $312,000. Right? You notice that this is the same. However, I have now an opportunity to rent. And so if I make the product, I cannot rent. If I buy the product and leave idle, I also cannot rent. I don't get any additional profit. But if I buy the sales from the outside manufacturer and then rent the space, this gives me an additional $80,000 in profit opportunity. Well, this acts as a reduction against my total costs. So now the total costs to make are $264,000. Option 2A is to buy, and option 2B is to buy and rent. So the cost of option 2A to buy and leave idle is $312,000. But now the total relevant costs, or relevant costs offset by any opportunity, is $232,000. Well, this now changes things a little bit, doesn't it? Because the difference between these two is a $32,000 difference in favor of buying the sales from the outside manufacturer and then renting the space. So the decision is buy and rent excess space. You could have alternatively put the $80,000 as an additional cost to make. But I'm just going to illustrate that down here real quick. Or, so the cost to make right now, $264,000, idle and rent. This is $312,000. I could treat this rental opportunity as an opportunity cost. If I choose to make instead of buying from outside and renting the space out, I now incur an additional $80,000 opportunity cost. So it makes the cost to make more expensive. This is $344,000. And I would actually also add that opportunity cost to the option of buying and keeping idle because I wouldn't get the extra revenue there. So that actually makes this $392,000. But look at the difference. $344 minus $312 is still $32,000. Still in favor. Outsourcing and renting. This is the lowest cost option. The third part was asking about some qualitative factors to consider. These can include things of, will the price remain stable from the outside manufacturer, quality of the outside supplier, potential for supply disruptions, and any others you can think of that would be relevant and appropriate. So that's it. That is an illustration of a basic make or buy decision, and then a make or buy decision with a revenue and profit opportunity. Hope you found this useful.